All right, so just gonna take a look at some trades on on gold and I think the ES. ES I missed. So anyway, so what happens is the market goes into the resistance area, the resistance zone, right? So this is zone of resistance. One of the things I see is it gets overbought right there. Okay. When it gets overbought is just a big move. It's just a big move without corrections. And you can, I mean, there's logic you can add and all that, but it's pretty straightforward. You have a big wave up, it's on top of a trend, etc., right? So you don't have to be a genius to see that this is overbought. I mean, there's other logic that you could use to determine overbought. It has to be in an uptrend, the length of the wave, and other stuff. And then this is the biggest wave in 19 up waves, so it's on top of the trend. So there's chances that this is overbought. And then it does what more? What is it? Shortening of the thrust right there. Typically, that's what you get. You usually get overbought and either up thrust or shortening of the thrust, and then it reverses. So that's what happened. It did all that in an area that I was expecting, in a selling area. And you need that. You need to know the levels in advance. Otherwise, you you don't you're not ready. So it does this dance right here and goes up and then goes down. This I cannot tell you how many times this right here happens where you have like it's like you see this little wave, corrective wave. This actually is distribution, but folks don't realize that this is how it happens. It almost looks like what is it? I forget what it's called. Not bull flag, but bull something. Goes down, up, down. When you're down, up, down, it looks very bullish, but it's not. Then it goes up and then it cracks. Why? Because this left-hand side right here with all the overlapping bars is distributive. It's distributive action right there. And then and the other thing is that's in selling zone, then it just goes up and then it cracks. On the biggest price wave in 21 waves. 21 waves. With the biggest volume in 15 waves. So, after that, you had the biggest volume in 22 waves that couldn't take out the high. And there's a reason for that, and I'll go over that, but the idea is that it's effort. Anyway, so it has this little dance over here, then goes up, and then it goes down. That right there is some type of upthrust after distribution. This is like more practical upthrust after distribution. We go where it dances like this, it goes up, like corrective action with a lot of overlapping bars, then it does upthrust, and then it has a change of behavior. Very important to mention that the change of behavior came from the extreme high. It's coming from the high. That is a very good sign. Very good sign. So let's put it all together. You have a zone, you have overbought, you have some distributive action, you have a high, which is your upthrust, and then from that. Now, if this thing pulled back and then did it, I would be hesitant. But the way it did this, it's basically creating lines of resistance up here. Lines of resistance. All right. So now, how will it look on the tape reading chart? Right? How does this distributive action look at the tape reading chart? Is right here, the 32, and then it goes up here, and it starts with more volume up here. Right here. So selling plus selling. Those white bricks tell me that, hey, look out. Why is this volume increasing? And the reason is it's in a selling zone, high volume in a selling zone, followed by this break means it's distribution. These two are distributive. That's about 3,200, that's about 2,700. Okay. And then it breaks, and then it comes back and retests, and then it really breaks and goes down. Now, what to mention here is you also want to use your profiles. All right, so you have your high volume, all of that, high volume prints, right? but you want to look at the lines, which will give you an idea of how much volume traded there. And I'm doing this because I went through the course, the study that I have it on YouTube. You go through it. This is what Wyckoff did when he was analyzing bases. He analyzed the lines. What he did was he would take a look at the lines and he summed up the volume. So what is that? That's basically a profile, right? So he would look at the high volume prints. So over here, what he would do based on his study is say, oh, look, there's 3,200 shares traded here and 2,700 shares traded there. Point them out because they are high. These are high numbers. Okay, so he would point them out. Second is he would take the entire line and he actually summed up the volume. And over here it's about 10,060, and above that is about 6,000. So in this distributive line and above it, 16,000 contracts. That's you know, this is not small money here. All right, so across that line, establish, and then finally it breaks. And then pull back and break down again. And this was the change of behavior. Again, remember, signals don't mean anything. Signals are garbage unless they're coming from a level. We do not analyze in between the range. It's pointless to analyze between. As you know, trading around the edges, you know, always look at the edges. If you read that book, Weiss's book, I forgot it was called, Trades About to Happen. The first thing he says is, where do you find fish? You find them at the edges, and that's where you find trades. At the edges. What are the edges? Basically support and resistance. All right, so it's in that edge. Does all this shaking and dancing over here, oh boy, and then it breaks. All right, it breaks. Okay, now when you get concerned is when, you know, it comes back in near demand area. The demand right now is actually within this white levels in this area. So I mean, it didn't go down there yet. It may go down later on, maybe, you know, overnight, it'll take out the overnight low or something like that. But as it got close to that area, what do you think happened? Oh, look, isn't that interesting? The same thing that happened up here with the big prints over there and then, you know, reversing down. The same thing, the big prints come in. Someone is base buying or building a base. Someone's accumulating, right? These prints, they're not random. Like if they're within, if you have high volume near established levels, they're not random. And how we know is because those levels, they're not arbitrary levels that, you know, calculate this plus this and create it divided by 2. None of that. These are where the market was bought or sold before. And that's why we look at those areas to see if those buyers and sellers are still there where they already bought or sold before. That's what makes those levels important, because they are spots where the buyers and sellers have bought a lot before and rallies originated from there. So, you know, up rallies and all that, they originated. So those are just prior buying and selling areas. So as it goes down, all of a sudden, oh, look at that, 3,100 gets picked up, 3,600. You have this go up, and then if you see this and you see this, and look what happens after, boom, right there, takes out the high. Now, the only problem with this, which I don't like, is you have to kind of like, these are guys going to fight these guys, and it might be a little move, and I don't want to play with little moves because it's not really worth it. You don't get that 3-to-1 risk reward. You must have at least a 3-to-1 risk reward to put on a trade. That's also, by the way, a buying and selling test, right? So anyway, you have that break with the base in the background. The base in the background has accumulation print here, here. All right. What else does it have? So I guess you can consider one of these a climactic. Anytime you have like on a red tick in a zone that goes down heavy, those are climactic prints. And to some degree, you see this volume here? That's not the biggest volume. Here's it. Here the volume increases. This is the biggest price range. So I'm looking for volume, and look at these two. You see this red followed by this green? That red was the biggest in the last at least 3. So it's a lot of effort with a big print followed by the reversal. That's very bullish. It means, you know what this means right here? You have all that red and it just goes and becomes green with the biggest volume in at least 7 columns. It means that it's bag holding. Someone was selling and someone else was holding the bag open and said, all right, keep selling, keep selling, keep selling. And look what it did. Boom. All right, now it's getting really interesting, and I'm trying to figure this out. I want to see how this behaves. It's just that it's after hours, and I don't like to play that game after hours because then strange things happen during session changes. What happened here? You had some bag holding, some effort here, and then you had that break above the highs that told you the market to basically buy the pullback. The market is going up on increasing volume IV right here. Where's the increase? It goes from 8 to 10 to 24, and then it breaks out with a 28. Look, 8, 10, 24. Is that going down or up? Buy. That's pressure. 8, 10, 24. Just like over here, 1, 6, 13 to break that low, because you need that pressure. 1, 12, 19 over here. 1, 12, and 19. Is it increasing or decreasing? It's increasing. 1, 12, 19. Then it, to break that low, then it dips to 13, and then it increases to 25. You need that pressure. So you want to be able to, I'm not a big fan of just like reading arbitrarily, but you want to see that, especially near the levels. So over here, when I see 8, 10, 24, want to break that high, dip a little, and then more, right? And then it pulls back. What's interesting to me now is why is it on the test of this break, look at the volume. What is this? This is buying. This is bag holding or whatever you want to call it. As the market pulls back, buyers are in right here, white. Why? Why is the high volume here? Because they're buying the pullback. This is reaccumulation. As it pulls back and tests, buyers say, we want some. And then when they're done, they push the market up. And now it's breaking out. Now, what's interesting to me is this line. This line of support, or this line, after this base get taken out. Wait for the base to be taken out. Then I'll know for sure this is line of support. Why it's important? 17,110 contracts traded at around the 1971 price. Just like in the accumulation, you had about 11,000 contracts trade in this line right here, right? So in the 1965, then it broke out on increasing volume, then it pulled back, it formed a line of support, 17,110 contracts. But it needs to fully break for you to have conviction and get ready to get in on the pullback. All right, so this is, if you want to learn how to do this, okay, first of all, I know I have candles over here, but the candles are just for visualization. This is a point and figure. This is not a candle chart. This is a point and figure chart. Let me just make that clear. Wyckoff's tape reading chart is a point and figure chart, and in the X and O's he has volume. That's exactly what the same thing I built out. This chart is based on for study or based off of his work in the 30s. Yeah, so it's amazing. And it's not rocket science. You just have to get a point figure and put a footprint on it. The reason why I have these red and green candles is for my better visualization, so I can kind of visualize the up green, down red, you know. It makes it so much easier to visualize. I'm used to that. All right, so we're waiting for this to crack, and then this becomes a line of support. At the same time, not a good idea to trade now or later, because you'd be stuck looking at the screen or trying to manage positions and all that. But tomorrow, you know, if this market breaks out up here, and then this POC is right here, and this is not a bullshit, you know, this level is significant. This is your POC for the day right here, 17,000 traded along the 1971 line. So on the breakout, volume increasing, come back, more buying, hold, boom, more buying, 4,300 shares of common contracts, and then a break. So those are good levels. All right. Okay, and the one thing that's interesting me is right up here in this candle, right? You have extremely heavy volume in gold. So I don't know what it's going to do over there. Like, is it going to take it out, or is it going to react and go lower? So I just have that picture in mind. All right, that's all. Let's go to the ES. All right, as you know, ES going crazy. All right. So what happened today? So what happened? You had, I think this was on Friday. This action was on Friday. The market broke here and then pulled back, based out, and there you go. Load it up. Someone knew something and loaded it up. 56,000 contracts in that print and a break, right? So now what happens? They pull back. All of a sudden the numbers go up. 24,000, 29,000, 31 and 30,000 starts holding here, and that right there, before the break, before the move, just like here, before the move, what do you see? In the consolidation, before the move, again, in the consolidation, before the move, here 56,000 contracts, here 57,000 contracts, right there. And then the break. All right, so breaks 57,000, and they break the high with 55,000 with follow through, which means it's not effort, it's breakout break. So the white ones here were accumulating, right? And then the 55, important, why? It has a green thing around it, and it has follow through, so it's breakout volume. All right, so the other thing to note is this is your line of accumulation. How do you know? Look at this POC. You think that the POC is going to be in a base for no reason? No, it's not contraction, it's accumulation with a buildup of volume here. How much? 273,235 contracts across the 4356 level, around the 4356 level. They accumulated over 273,000 contracts, built the base on top of the prior base, broke out, and went into markup. Okay, how did it look on the wave chart? You have all this overlap, right? All this nice overlap. Now here's the thing, I really wanted this thing to go back a little bit more, but it didn't, so what are you going to do? I thought I was going to go back to this, but it was wishful thinking that it would come back here and give a very low risk opportunity. It didn't do that. I gave a little thing and just went berserk. Yeah, right here, and pull back. And then I realized that it was not going to give me a deep pull back, and just flew. And that's what happens. All right. So what do you learn from here? You learn that contraction is not just contraction, especially if you have high volume prints. This is reaccumulation, meaning you know, we're taught that, okay, the market is ranging. The ranging needs to be examined to see if it's reaccumulation or redistribution. Why? Because ranges are typically not just ranges. They are, as you see here with these big white prints, a lot of volume. The POC is within that base. What's going on? And then finally increase on a break above here on increasing volume. 28,000, 55,000, 58,000. So are they just, I mean, what's going on? One of the buying and selling tests, and why I wanted to have this increasing volume indication is because one of the buying and selling tests is volume is increasing on rallies. That's one of the buying tests, and then on the selling test is volume is increasing on the down rallies. So here you go, increasing volume. You get that indication, right? So anyway, this 56 held everything. This 56 here, 56,000, it basically made a line of support, and where was this? And that's where it rebased and went higher. So we'll just see what opportunities are there tomorrow. This is Wyckoff approach. This is it. This is the and I'll go back into the studies and continue that. But you get the idea. If you want to follow along, just go and get the Division 2 and the tape reading studies in the back of the Division 2 course. And then you want to get a platform that you have a point and figure with footprint. That's all you need. And any paid platform will have that. All right. Take care. Bye.